In one of the earlier videos, we had discussed in detail about the cash flows, especially for senior citizens and retirees. I remember having discussed it that post-retirement life into two phases. Phase 1 comprising of the age 60 to 75, where one is more active, maybe the need for money is far more higher, and therefore the generation of cash flow is far more important at that phase. And the next phase, 76 to 90 or thereabouts, or till end of life, which cash flows may be not as much needed, but thanks to inflation, maybe the amount will still be the same. We discussed this in detail, but in this video, we're going to not talk. We're going to let the numbers talk. We're going to look at how we can make these happen. And we have used a variety of different examples of actual fund performances across a category of hybrid funds that senior citizens and retirees can invest into and create a cash flow for themselves. We're also going to discuss about some government guaranteed options like senior citizen savings scheme and others where we can generate a steady state and a guaranteed return for whoever so desires. Let's dive right in.
The government guaranteed options for investing to get regular returns. First option is Senior Citizens Savings Scheme. This is a Government of India option that is available for people who are above the age of 60 years. The annual payment of interest works out to 8.2% per annum, payable on a quarterly basis. The maximum investment amount allowed is rupees 30 lakhs and the tenure of the investment is a 5-year. But investors are allowed to extend it for further periods of 3 years thereafter. The investment is also eligible for Section 80C deductions, but the interest earned by the investor is subjected to tax. This is one of the prime products for risk-averse investors post-retirement to park their funds for a regular cash flow. Next, Post Office Monthly Income Scheme. The Post Office Monthly Income Scheme currently offers 7.4% interest per annum. It's again a 5-year investment. The maximum investment in a single holding is 9 lakhs and in joint holdings can go up to 15 lakhs. The interest is payable on a monthly basis and one can open a savings account in the same post office wherein this interest can get credited and they can get a checkbook and use it as any other bank. It's a reasonably popular investment option, especially given that every locality has a post office and it can be operated through that. The third option is the Government of India floating rate bonds. The current rate is 8.05%, payable on a half-yearly basis, which is the 1st of January and 1st of July. It's a 7-year instrument, and as a senior citizens, you are allowed an early encashment option should you require to withdraw prematurely. The interest earned on the Government of India bonds is taxable, and there is a likelihood of variation in the interest every 6 months depending upon the interest rate scenario prevailing outside. But this is a great product because it has no upper ceiling. So one can invest as much as one needs to invest in these products and get the benefit of a regular cash flow. There used to be another option called LIC Vaya Vandana Yojana, which was a guaranteed pension of the Government of India offered through LIC. I believe it's got discontinued as of 31st of March 2023. For retirees looking at a regular cash flow, one another option that one can look at is hybrid funds of the mutual funds. As the name suggests, these funds combine multiple asset classes, namely equity and debt, in proportions to generate a certain amount of return for the investor. In this section, we are going to look at 4 options wherein retirees can participate in some amount of hybrid funds to generate a regular cash flow. This regular cash flow in mutual fund can be arranged through opting for a scheme called systematic withdrawal plan. The first option one can look at is equity savings fund. As the name suggests, these are funds where a certain portion of monies are parked in equities and a certain portion in debt. Usually the equity portion is capped at 40%, which means it's usually much lesser than 40%. The usual number is somewhere in the region of 20-25% is the average. So this is a reasonably safer option than more aggressive equity funds. In the actual scenario where we had done a backtesting of this from 2012 to 2022, if an investor had parked 1.2 crores into equity savings fund to generate a return of 50,000 rupees every month, then after drawing 50,000 every month, at the end of 10 years, they would have been left with anywhere between 1.5 to 2 crores. We have taken a sample of funds. That's no representation. This is just a very, very average performing funds that we have picked up at random. And the rate of return has worked out anywhere between 7.5% to about 9% or thereabouts. So this is how this fund will perform. Maybe 8 is a good number for you to have with a fair amount of safety, but can provide you at the rate of 6% a regular cash flow. The next fund to look at is a fund which we call the Balanced Advantage Fund or Dynamic Asset Allocation Fund. We've used the same numbers, same timeline, same period of 10 years, and for every 1.2 crores at the rate of 50,000 being the amount drawn every month, this portfolio leaves behind a corpus of anywhere between 2.8 to 3.5 crores at the rate of 12.5 to 14.8. Yes, the returns in these category of funds are slightly higher. Balanced advantage funds are very dynamic funds where the equity component keeps changing. It can go as high as 60%, it can go as low as 40%. Usually it is 40-50% of the overall portfolio, but it categorizes as an equity fund because the fund manager will use a buffer of 10-20%. So if equity is 40% and debt is 40%, the rest of 20%, the fund manager will use arbitrage kind of products which are categorized as equity, so that this fund will have 60+% in equity. As a result, it qualifies as an equity mutual fund from a taxation perspective. So these funds typically will have at least 40% in equity, sometimes as high as 50 or 60%. So they are a little bit more aggressive in terms of equity exposure, but combine it with debt to generate a much higher return for the investor. The next fund we are going to look at is called the aggressive hybrids. The aggressive hybrids are funds which will hold at least 65% of their portfolio in equity, come what may. 35% is held in debt. These kind of funds are essentially meant for people who don't want to take the exposure of a pure equity fund, 100% in equity, but want to combine it with another asset class. So the debt portion plays a certain amount of stableness in the portfolio. But rarely would the fund ever move below 65% because it wants to continue to enjoy the equity taxation benefit. So therefore, these funds are considered a very high risk among the three that we have discussed so far. In the same example of 1.2 crores of investment done over a 10-year period, the investor is left with 3.7 to 4.2 crores at the end of the day, with a return of about 15 to 16%. So as the equity component has been high, so has the return. The last fund that we are going to look at is a category called multi-asset. As the case may be, this category of fund will look at 33% in equity, 33% in gold, 33% in debt, or some combinations thereof. Typically, these funds are more protected against any event primarily because they have three asset classes among which they are diversified. In the current example of 10 years of investing, these funds over a 10-year period after paying 50,000 rupees every month have left the investor with a balance of anywhere between 1.9 crores to about 2.4 crores as the case may be, generating a return of 9 to 11%. So this is how the multi-asset funds have performed in the past. They are a little bit more sober option in terms of generating returns. So I would say from a safety perspective, the best funds to go after at this point in time for senior citizens or senior investors who are looking at a regular return is to look at equity savings fund as the first option for their systematic withdrawal. Then you have the multi-asset funds. Then you have the balanced advantage fund. And last, if you have the appetite for taking slightly higher risk, then aggressive hybrids are also something that you should look at.
As we have seen, there are a variety of different options available for senior citizens to plan their cash flows post-retirement. So, retiring need not be that fearful and daunting activity anymore. I hope I have been able to convince you that either from a safety perspective or from using hybrids, there are enough opportunities for senior citizens and people on the verge of retirement to create a cash flow that will continue to work for them in the long term.